Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everyone. Thank you so much for being here on this edition of the REI Hacker Podcast. Really excited for my next guest. His name is Scott Carson. He is a Texas native turned nationally recognized expert in note investing, where he does buying, selling, and he also teaches others how to profit from performing and non-performing debt. He's the founder of the Note Closer Show and one of the top educators in the field. Scott's been featured in the Wall Street Journal and Entrepreneur magazine. With more than $1 billion in distressed debt underneath his belt, he continues to help investors nationwide build wealth through creative finance and other interesting strategies, including notes. Scott, thank you so much for being here. I appreciate it.
Benson, I'm honored to be here with you, man, and just here to serve your audience. Yeah, you read that stuff, it's hard to believe we've bought that much non-performing stuff over the years, you know? It
is insane. Those are big numbers, right? And, you've been around for a while, 15 years plus. You've been doing this, and I'm sure you've got a ton of exciting stories and things that you've done through the years, but let's break down the basics of note buying for the audience so they can get a good foundation of where we're at, and then we can talk more about some of the stuff you've done in your career.
Yeah, no problem whatsoever. Most people, when they hear me talk about, or here's me talk about note buying or note investing, it comes... Really, most of the time people think about, oh, you sold your property on owner financing. You sold it on terms to somebody. And that's one facet of note investing is where you're selling or buying on terms. Well, I do a little bit different approach because I used to be a mortgage broker, mortgage banker back before the crash and everything in 2007, 2008. And so I had a mentor that taught me the actual note buying business of structuring and creating owner finance notes and buying and selling that at the closing table. But when everything hit the fan, I started getting lists of non-performing mortgages from banks and lenders sent to me from the people I was originating loans for to literally stuff they were trying to sell off their books. And my mentor and another investor of mine were like, man, this is the best time to be buying it distressed debt. And so when we talk about my niche of note investing, it isn't buying owner finance notes. It's literally getting these lists of mortgages, first liens on residential and commercial properties from lenders, banks, hedge funds that we can actually buy at a big discount because the borrowers, the owners, haven't been paying for a period of time, usually 6 months or longer. And so banks are willing to sell this debt to me at a big discount. And I buy that debt at a discount. I don't own the property, but I basically become the lender, become the bank, have all the same rights that the lender does, and we make our money by buying that debt at a discount and then working it out with the homeowner or the borrower in some sort of fashion, either to stay in the property by either starting to make payments again, bring some money to the table what they're behind on. Sometimes we'll do a loan modification or forbearance agreement to keep them on pace. And that turns into cash flow for us. And after a period of time of them paying on time for like 12 months or longer, it's now considered a reperforming note that, I could turn around and sell back to Wall Street now. If I bought the note at 50, I could turn around and sell it at 85, 90 cents on the dollar. And that's how we make money on that without actually owning the property. Now, in some cases, the borrower won't play ball with us. They just don't want to do anything, or maybe they can't afford to stay in the property. So we'll work with them to turn the property over to us, doing like a deed in lieu foreclosure. Or if they want to play hardball and don't want, pay, stay, we'll go the route to foreclose because we have the same rights to do that. And then we'll take the property back if we don't sell the auction for a profit. So that's kind of note investing and what I do in kind of a small nutshell for you there.
Got it. Is one strategy more profitable than the other? It's getting it through the foreclosure process at a big discount more profitable in the long run if you can sell that property or rehab it or do something to it than just making it performing again and getting that arbitrage?
So that's a good question, and the universal answer to any real estate investing answer is depends. Exactly. Yeah. So the way I look at it, my first 2 years as a note investor, I bought and foreclosed on everything. I bought it at a discount. I wouldn't modify anything. I would just foreclose. And every state's a little bit different on the foreclosure time frame. Some are very fast, like Texas here. We can foreclose in 21 days. Georgia's 30 days. Any non-judicial foreclosure states can be a little bit faster. And then you have the judicial states that you have to go through the court systems, like Ohio, Indiana, Florida, or as I call it, God's waiting room. Illinois is a judicial foreclosure state. Those take longer. So when you can make good money buying a note at 50 cents of the dollar, foreclosing, and then either selling at the auction or rehabbing and taking it back. But when you look at the foreclosure time frame, some of those things would take a year to foreclose, 6 months or longer to foreclose on. If it's an occupied asset and the borrower is willing to actually start paying on time again, it can bring a little bit of skin in the game of what they're behind on. And the fact that I could turn around in 12 months and sell it at 85, 90 cents on the dollar without having to fork out any type of attorney fees to foreclose, reduce servicing costs to service that note, and then, of course, no rehab costs to fix it up or sell like that. The bigger bang for the buck, 7 out of 10 times, is actually to keep the borrower in the property, Benson. And the yields numbers don't lie. Now, don't get me wrong, there are times that we buy stuff that we know we're going to foreclose on the borrower just because they haven't paid anything that, our due diligence shows they're not going to be a good borrower and we have to go that foreclosure route. But honestly, that's like I said, if it's owner occupied and somebody's still wanting to work with us, 7 out of 10 times, it's going to be a better situation for us to keep them in the property for the cash flow. I don't want to own real estate. I've been a landlord before. I got tired of getting phone calls. Yes, you have property management. We all know property management can be difficult to find good folks for that. It's just a bigger bang for the buck because nobody calls the bank when little Timmy flushes the rubber ducky down the toilet or the AC goes out in the middle of summer. You know what I mean?
So it definitely depends. And obviously you've selected certain markets where you like to operate. There's just better circumstances for you as the bank. And I guess if you're leaning toward the cash flow situation anyway, I guess it doesn't matter as much if it's a judicial state. If you're trying to keep them in the property.
Exactly. Yeah, exactly. Now there are some states I just won't buy in, period, because they're difficult. The New York's where it takes 3 years to foreclose, that's a no-go. New Jersey, which can take you up to 2 years to foreclose, no-go. I don't even like buying in Chicago.
Yeah.
I'll buy outside of Crook County, as I call it. But in Chicago itself, it's very difficult if you're an out-of-state investor there to foreclose, evict somebody. The court systems and the judges there always end up giving the local folks extra time. I bought a portfolio of notes a few years back in Chicago and lost my ass. I bought them at a good price, but the delayed foreclosures and then people breaking back into the properties and the trashing and, I had one property we rehabbed 3 times because it kept getting broke in. Even when we put like steel walls on the doors, people would break in, steal the copper, all the utilities. And so I don't buy in Chirac, as I call it. Wow. It's too rough an area. Now, if I lived there, it'd be a different story, but out of state, it's just not good. But the rest of Illinois, Lake, DuPage County, other parts, I like. But that's just a rough area. I like Tennessee, too. Tennessee's a relatively faster foreclosure, non-judicial state. But Memphis is not a very great place to be in because it's you really need to know Memphis on a block-by-block basis. Some areas are good and others are just rough.
Yeah. Yeah, a lot of those Midwest areas are like that, right? And it probably actually, let's not say that. I was gonna get political for a second, but I think maybe I'll stay away from that.
Well, I will say, if you're using a lot of times we've seen in sanctuary cities across the country, not just the Midwest, it's not good to invest in those areas as an investor. Because if you're trying to evict or tenants or foreclose, it takes a lot longer and it drags stuff out. There's plenty of opportunity. I invest about 20 to 30 states out there. I've bought in 40 different states across the United States here. But you'll run into some issues in some areas and stuff like that. Yeah. You just got to understand what's going on and how friendly the local foreclosure tenant laws. I like Indianapolis, and this is great. I can evict in 14 days. I don't want to evict, but if I have to, it's a judicial state that takes about 9 months to foreclose. I can still evict a tenant in 14 days once I take the property back,
right,
or keep it.
It's a lot of moving parts, a lot of things to keep track of, to make sure you're taking advantage of all the strategies that are out there. But this whole time that you've been doing it, you've seen lots of different market cycles, right? You've seen, saw the Great Recession, right? Because you got started right before that, and probably a big eye opener. But even since then, we've seen some ups and downs. Where do you see the opportunities and maybe even the dangers in the upcoming cycles based off of what's happening now? Do you see this as a good time to buy notes, or is it a time where you should really kind of just make sure you're doing it the right way?
So with any type of strategy, there's a variety of moving parts. Just every strategy out there. There's no perfect strategy unless you actually dive into it and understand what's going on. I mean, I like notes because, I get stuff at bigger discounts. Notes are really kind of recession proof. If I'm buying something at 50 cents on the dollar of what's owed or the value, if the property values drop 10 or 20%, we're still sitting in a good position. Also, if I'm buying a performing note, the borrower has been paying on it, I don't really care what happens with values going up or going down if it's an owner occupant, because they're going to be in there usually 7 years or longer. So it kind of irons out those quick peaks and bursts. The fix and flippers, I don't really like to do a lot of fix and flip. I mean, I'll take the property back and fix it up and sell it at that point, but I'm usually at such a lower cost basis than most of your REO buyers because we bought it and went through the foreclosure process or bought it at a significant deal and saw these deals. And that's the great thing is when you're a note investor, you're seeing deals 6 to 12 months ahead of what most traditional real estate investors are seeing. I mean, the ability for us to buy the debt and keep a property from hitting the foreclosure market or the MLS actually keeps values up and gives us a kind of an added opportunity because banks are sending us lists on a regular basis that aren't necessarily always publicized or out there on the they might show up on the list once we get around to foreclosing on it, but it's often gives us an added advantage of getting this stuff direct from the banks. Now, you have to be aware what's going on with the markets too, that we take a look at what's the future of. And I really do believe that we are starting to see that markets soften. You're starting to see values kind of drop as people are looking to sell. It's a buyer's market versus a seller's market like it used to be. You're starting to see days on market start to climb up. So we've adjusted what we buy. I like to be in that first time home buyers under $400,000 value for the most part because those things are still relatively moving, and that obviously will vary on a market by market basis. And knowing different things that are happening, like what's going on with insurance in the Gulf Coast or Florida. That's a tough thing. Hurricane season, not being able to get cheap insurance in Florida can kill a deal. Mm-hmm. So there's different things to keep up with. I always tell folks, listen, focus on 3 to 5 states when you're starting off with. If your home state's got plenty of distressed debt, that's a great place to start. Like if I lived in Ohio or Michigan, that's probably all I'd buy. I almost moved to Florida a few years back because I've bought so much stuff in God's waiting room back in the day. Texas, while it's the friendliest state to be a lender in and fast foreclosure laws, stuff like that, we've also got high property taxes, which make it a little difficult. And then also, if you're on the Gulf Coast, the hurricane insurance. So every state has its pros and cons, and the idea is, okay, look at a couple states, understand if it's an owner-occupant and you're in the note business, which all the big banks are for the most part, they don't necessarily want to own real estate. They want to own the debt. And the way you can leverage debt and then the returns that come from it with a cash flow basis or the difference in cash flow on a note versus a fix and flip or landlord, I think it really outpaces of what a lot of people are looking for. And the fact these days that we can actually find deals, whereas a lot of other places aren't finding deals that are profitable anymore.
Right. A couple times you've mentioned owner occupants. Is the process different, or is your strategy different if it's a non-owner occupant, like an investor who owns a rental property?
So the way we look at it, it's a little bit different because an owner occupant will often have pride of ownership. You can tell, doing a little due diligence on a property, you don't have to be too smart to see when it's an owner occupant versus a landlord tenant in a lot of cases. A tenant occupant. An owner occupant is usually going to take better care of the property. They're going to have some pride of ownership, landscaping. They're just going to take better care of a property. A tenant, a renter, you're going to have more wear and tear on the property. They're probably not going to be fixing that little water leak or the faucet leak as fast as somebody's an owner occupant. So that's the thing. I have more value, and I'm more likely to get an owner occupant back on track faster versus an investment property. Sometimes because you got to remember, we're dealing not really with the tenant, but with the actual owner of the property. So depending on what's going on with that landlord, we see a lot of times landlords are, if they're behind on one mortgage payment, they're usually behind on several, and robbing from Peter to pay Paul. So sometimes it can be a little bit easier negotiation with the borrower if they're not playing ball on a rental unit, because like, listen, if you don't work with me and we don't get this taken care of, we're going to put a judgment against all your properties in this LLC. So let's work together. And then it's also too, in commercial notes, if somebody's got a commercial property, like a small apartment complex, stuff like that, written into these mortgages is once that borrower defaults or stops paying on time, we usually have the right to go in and collect the rents on a multifamily property. So that takes a lot of the motivation to fight us out the window. Like, once we enforce that, there's no playing ball anymore. It's our way or the highway for them in most cases.
Right. So you mentioned earlier that banks will come to you. Is it kind of their standard process to go to maybe see if someone will buy the note before they start the foreclosure process?
We'll see. We've seen more and more of that, yes. So we're not going after Bank of America, Chase, Citi, or Wells Fargo. The big 4 or 5 banks, they're not going to sell a smaller portfolio off or even a one-off. They're going to want to sell like a $50 to $100 million portfolio to another fund, and it's not going to even be that good a discount. But we make majority of our purchases from mid-sized banks, mid-sized lenders, even some hedge funds who are non-bank who are making loans. So yeah, I mean, it's all about getting into the right department. You're not going to walk into your local, Bank of Aurora or Bank of Denver and say, "Hey, I want to buy your notes." Mm-hmm. They're going to tell you you're an idiot and get the heck out of there. I mean, as an ex-banker, J.P. Morgan Chase, I used to say this thing, "Oh, we don't sell our notes," okay? But when you get into the right department at the bank, that's why it's so unique in the note business. Is such a niche aspect. It's every bank sells their debt. You just got to know who to talk to and what size of debt sale they're looking for. So most banks, most small lenders, especially commercial banks, stuff like that, they're willing to sell one-off notes because that non-performing note is costing them 8 to 10 times that in what they have to hold back and fees that they can accumulate along the way, along with leveraging the money it's that they have to hold up for in reserves. So if you go to LinkedIn, which is free, go into LinkedIn and type in special asset manager. That's usually the job title for a major institution. Special asset manager. You may also look for secondary marketing manager. That's going to be a mid-sized bank is often going to have somebody that goes by that title that handles the note sales. Insurance REITs will have something called whole loan trader. And then you can always go to smaller banks and look for their chief credit risk officer. Those 4 job titles, what most people in these different lending institutions and hedge funds go by that handle the debt sales. So that's one thing that we've done over the years. Is we used to do a lot of dialing for dollars, making 50 to 100 phone calls to find out who the right person is to get access to these lists. Now LinkedIn makes it a little bit easier, but it's still a lot of following up with folks. And yeah, some banks will send stuff out once a month. Some will send it out once a quarter. Some will do it only once a year. We prefer to target banks that have at least 5 branches. You get anything under 5 branches, they're usually too tight on their lending restrictions. They can't take a big loss on a note sale. So that's fine. We'll work with them in a variety of other fashions, but still, with that mid-sized bank is where we see the biggest bang for the buck. And once you're into it, these note sellers are usually going to send a list out to you, like I said, once a month, most of the time. And it's not a all or nothing 99% of the time. It's usually, hey, we've got these notes we're looking for sale. Would you give us an offering? What would you offer? And it's a negotiation process like in anything else.
Right. And that's what's good, too, about your community. Like, you may not want to buy them all yourself, but you can get these to your students who are just trying to get going and maybe don't have the vocabulary or the salesmanship down yet to where they feel comfortable calling and talking to one of these departments that get the notes sold. But you can get them to them, right? Just by being an intermediary.
That's the thing. People always ask me why I started teaching note investing years ago. I said, well, I couldn't buy it all myself, right? There's so much of stuff coming out that it made sense for me to start teaching people the differences between buying a note and buying a property and the advantages and disadvantages of both and how to do it. Now, I'm not buying the note and handling the servicing ourselves. We're not handling foreclosure ourselves. It's a vendor-driven business. So teaching people like, hey, you need to know how to find these deals and how to fund them. You need to use cash or IRA funds or other liquid assets. But you use servicing companies to handle the collections, the borrower outreach. So if you're looking to be like a passive investor, sometimes performing notes or reperforming notes are a great tool for you because it's pretty much hands off. Yet if it's a performing note, you put it with a servicing company, $35 a month. They're collecting, sending you an ACH transfer, and communicating with the borrower. The borrower, if it has any questions, they're calling the bank, not you. If you want to be a little bit more active, non-performing can be a great way too. Same thing. You put it with a servicing company to cover your licensing requirements across most states, and then you're going to hire an attorney to handle the legal or foreclosure process if you go that route. If the servicing company's not able to work out something with the borrower on your behalf to begin with. Mm-hmm. So yeah, it's a great thing. Is people always say, well, I tried to do this 15 years ago and I didn't have $5 million. I said, well, it's a good thing. Guess what? You don't need $5 million now to do it. You don't need $1 million. There's a lot of smaller balance notes or even smaller properties with notes on them across the country. I mean, your market in Denver and mine are pretty expensive. You're not going to see a lot of stuff below $100,000 in our markets, but there's still other states and cities out there and stuff like that. You can pick up a good first lien, at a 40, 50% discount off what the value is, and work it with a homeowner and get a $300-400 a month cash flow coming in off it, and not ever have to fix it up or, like I said, deal with toilet stands or trash outs.
Are you only buying first notes right now?
Great question. Yeah, I only buy first liens. I've bought some seconds that were behind my first lien, mm-hmm. but for the most part right now, 99.9% of the time we're just buying first liens. You don't want to buy a second lien. Second liens are much riskier, especially if it's a non-performing second behind a non-performing first. You can get wiped out. It's also, right now, seconds are way overpriced. I mean, you used to be able to buy second liens at like 5 cents on the dollar back in the day. These days, they're way overvalued, overpriced, and you especially don't want to buy an overpriced asset when you're starting to see the markets kind of dip in values a little bit. Those second liens might look really good that you're fully encumbered, but now as values are dropping in different parts of the country, you may hold a note that has not got any value to it.
Right. Back during that time period in the late 2008s, 9, 10s, I was buying liens, but the whole point wasn't to get them to perform. It was to be in a redemption position where I could redeem out the ones before me and then get access to the property. And what we're finding is that like second lien holders just weren't redeeming; they would just fall off through their redemption process. So we would buy like municipality liens, HOA liens, other like mechanics liens, those small liens. Like you could get them for like an HOA lien for like $100.
Yeah, cheap, real cheap.
And then you're an owner, right? And then you just can redeem out anybody else. But maybe a property that was at 80% of the ARV with a second and a third, those liens fall off. Now all you have to do is just pay off the first, and now the property's at 50% of the ARV.
Yep.
Do you use any of that
we
now,
bought some
or
HOA liens.
You're not playing that game at all?
Yeah, you still do. You still do that same thing. We used to buy a bunch of HOA liens in Florida, direct from the HOA, second liens, and they were always usually behind, like, we would see who the lender on the first was, Bank of America, Chase or City. Well, we knew it would take them years to get around to foreclosing off, so we would do a quiet title. Buy the second HOA lien for like $10,000, do a quiet title action in 12, 24 months where the Bank of America attorney didn't show up. Well, it got erased. Now we held a condo for $100,000 that we bought for 11 that we have held for cash flow for the entire time.
Wow.
So you can still do that. I think more attorneys have become wiser to that niche. We don't see as many HOA liens from condo associations coming up for sale, but every once in a while you'll see them, and you still do that. I mean, I think there was a store the other day, somebody buying an HOA lien in, where was it, Michigan, and he ended up with a house or two that the borrowers didn't think about, So, yeah, you can buy it varies state by state on what you can do with it as far as foreclosing. If the HOA lien will take, prior to Colorado it does, Las Vegas it will, and Florida you can buy the second, won't wipe out the first, but you can evict subject to the first lien and take control of the property.
Yeah, there's so many strategies here, and when I think about like traditional real estate investing, let's say like a landlord, there's like 4 main revenue streams, right? So you got cash flow, appreciation, depreciation, and mortgage pay down. right? Are there those kinds of things in note buying too? These multiple streams that you can take advantage of just by, buying these things?
Yeah, I mean, you get, if it's a non-performing note and you're willing to let the borrower stay in the property, we always ask for skin in the game up front, so like a down payment of some sort. Because if we don't get some sort of skin in the game from them on the front end, 85% of the time they're going to default. We're going to have to foreclose. So yes, we always try to get some skin in the game on the front end. You get monthly cash flow based on the mortgage payment, and then you get a payoff in the back end, because most people will sell off their house or move in 7 to 8 years, or will refinance you out with a cheaper mortgage rate in a lot of cases. So yeah, you have that big pay down on the back end. Now, the great thing is you're buying this stuff at a bigger discount. You're not putting 20% down and financing 80%. So there's that difference in what you paid for and what the balance is on it. We don't get cost segregation or depreciation on a note. There's no 1031 exchanges with a note deal. But when you buy enough non-performing notes, especially when they owe more than the property's worth, you can always 1099 them for what you write down or forgive, but you don't get as a tax write-off too. So it kind of offsets that a little bit. I was just advising somebody who's doing a 1031 exchange. They wanted to go into notes. I said, well, you can't go into notes. What you can do is you can pay cash for a property if you want to do. Go find your property you can pay cash for, use that 1031 to go in it, and then take a line of credit out and use that line of credit to go buy some notes. And then you can write off some. And of course, when we foreclose, we take the property back, and now we own it. Now we can do the depreciation, the REO. If we want to hold it at that point, do a cost segregation analysis if it makes sense, and go from there too. So I like doing that stuff. So it's just a little bit different asset and different things that you can do with it as well.
Do you have a rule of thumb for the discounts that you need on a property before it makes sense? Like at least 40%, or does it just depend again?
So that's a very great question. If you're going to buy in a state like Texas or Georgia that have such fast foreclosure laws, you can go above, I would pay up to 80% of the value of the property, or 80% of the, I'll even go like 85% in Texas if foreclosure is going to be in 30 days. Because if it'll sell at the auction and I make 10 to 15% in 30 days, that's a pretty good annualized return, right, Benson? But if it's a longer foreclosure process, I'm definitely going to want to get a bigger discount. So looking at where it is in the foreclosure process, if it's just starting off, you want a bigger discount, usually somewhere around 40% or greater. And then the great thing about us when we're buying these notes, we're literally getting all the servicing notes. So we can see how difficult that borrower is going to be. We can also see the borrower sending sort of communication into the lender, previous lender, on if they want to do sort of any type of modification or forbearance agreement. So that helps us to kind of calculate the yield of what they have presented to the previous lender, what kind of modification. So I like to, pretty simple. When I get these spreadsheets in, we'll immediately take what the P&I payment is, the principal interest, multiply it times 12, and then divide it quick number-wise by, if the property has a ton of equity, where they owe less than the property's worth, then we're probably going to bid around 80% of the balance of the note, not the property. And then if it's upside down, we'll look at about, where they owe more than the property's worth, about 65% of the value. And so taking those 12 months of payments and dividing it by what that rough offer, we're going to look for about a 12% ROI just on that basic cash flow. So that's a kind of a quick judge of character. We like to see 12, 16% or greater, depending on what our money costs are going to be. If we got a private investor who wants to make 8% of the money, then we're going to look for probably a 16 yield on something like that. Simple. With the idea that if we do take buy that note, we're going to get the borrower to bring some extra money to the table, and not recalculating that exit strategy because we don't know which way it's going to go for another 12 months. But yeah, running some simple formulas so we can see, okay, what's going to make sense, what's not going to make sense. We don't buy a lot of low interest rate loans like mortgages that have 3% or less. It's just hard for us to make a good yield on those without having to buy them at 10, 15, 20 cents on the dollar. No lenders want to really sell off a note like that at such a huge discount, especially if it's under a year in non-performance.
Would there be an opportunity to sell those low mortgages to like sub-2 investors?
So you're not buying the mortgage, but you could technically target that list as a sub-2 investment.
Right.
One thing we've done is when we get these lists in their low interest rates like that, we know it's not going to make sense for us. We will target the borrowers, the homeowners, potentially for subject to deals. Hey, don't lose your house to foreclose, or don't let a foreclosure losing your credit. Let's work out to help you make it a win-win. And those can be very good subject to leads, or subject to deal leads for you to turn around and either rent them out once you're taking the mortgage over, or doing a wraparound mortgage and owner financing the property. In some states, doing a rent to purchase or lease to purchase. Can't do that in Texas, but you can do that in other states.
Gotcha. Yeah, those low interest mortgages are super valuable right now.
I think so. I'm always surprised that more people don't approach that, because you got to realize when we get the spreadsheet in, when we get this tape, we call it in our niche, it's got everything about that borrower, the borrower's name, the last 12 or 24 months of payment history, all the details about the mortgage note, when the last payment was, when they originated, the existing balance. So it's pretty easy to run some formulas in there and say, okay, these are in states that I want to own real estate in, and so that's one thing that we do. Is like I got in a list just yesterday of 133 non-performing notes, all low balance, 4% or less. There was a couple that were at 5%, but I pulled the Texas and the Georgia ones and the North Carolina ones, because those are all relatively fast foreclosure states. And then I like Indiana, and we're going to do a postcard letter campaign to those borrowers, see if we can't take over some subject to deals, because like you said, it's gold if you got a property with cheap money on it, for sure.
Oh, yeah.
Do I need to send you some leads for the states that you're buying in, Benson?
Yes. Yeah, I would love that.
What states do you like to invest in? Besides Colorado, I know that's where you're at, right?
Yeah, I like Missouri and Arizona as well.
Very nice. I fast foreclosure states. Yeah. Missouri is about 90 days. Arizona's about 90 days. It can actually be 60 or 90 days. I can never remember Arizona, but still, it's a lender-friendly state. Yeah. So, yeah. You want to stay in Phoenix, Tempe, or you don't want to be out in the middle of nowhere? But
yeah, anywhere in that main area, Chandler, Phoenix, Tempe,
Glendale,
yeah,
Scottsdale area,
within a rock's throw. Yeah. You could hit any of those from just by throwing a rock, right? If you get out to like Tucson, or you get up way far north, that's just a little too far away. But right in that core. Sure.
Okay, I will keep that in mind. Definitely, Arizona. Arizona, you've got a lot of distress going on there in the Valley of the Sun and stuff like that. So you do have a lot of folks that are trying to sell their house. I back in 2010, I was buying debt on $300,000, $4,000 properties, like $30,000 a pop. Wow. Phoenix literally was like, they had 10,000 REOs, foreclosures, that they had in the market, but they couldn't release them all at once. Otherwise, it wiped out the value forever in Phoenix. So they're releasing like 1,000 foreclosures on the MLS at a time, and waiting for a lot of those to get sold off before they release more of them. So yeah, bought a lot out there in Phoenix, that neck of the woods.
So remind me, so you said that the list that you're getting of these notes that people want to sell, or that the banks want to sell, this is before they've recorded anything at the county, right? As far as like starting the foreclosure process, usually.
Sometimes they've already started the foreclosure process. Sometimes they haven't. It just varies on the lender. Some might have a mixed bag where they're like 30 days from the foreclosure auction. Some of them where the mid-summary judgment's just been filed. Sometimes where it's just been referred to an attorney. It's really a mixed bag in a lot of cases.
Got it. Interesting. So
I see the gears turning there for you, buddy.
There's always opportunities, and honestly, this is one of the reasons why I started the podcast way back when, is to to network and find opportunities and learn some different strategies. And so this is for the audience, but it's a way for me to kind of just broaden my scope of what I can put my fingers into. And I started a fund recently, so now I'm looking to raise cash to do some more deals. So there's lots of reasons why this is good for everyone. It's a win-win, which you love, right, in this business, because
I love
this is part of like how you operate with your finding a win-win. It's an interesting balance, though, I have to say, because with note buying, these people are in distress situations, right? So it's like at its heart, and don't take this the wrong way, you're profiting from other people's hardship, right? But that's just kind of the way the world works. And we've all been in some financial situations that aren't great. Back in like 2008 and 2009, like I had some foreclosures because of some poor decisions. I over leveraged some properties and stuff.
Yeah.
So how do you balance that with being able to find a win-win, but also knowing that somebody is in a hardship situation?
So that's a really great question. So I was like you back in 2001. I bought my first property, and then I bought 2 investment properties, and then a month after I closed on my third one, I got laid off. And then my tenants got laid off. So I was a deadbeat borrower, is what I would have called myself back in the day. Didn't mean I was a bad person. It was just a bad financial hiccup. You know, I couldn't pay. My tenants couldn't pay. Got out of the bad situation with those 2. Kept my primary by doing a forbearance agreement. So I have a lot of empathy for people that are struggling. And so one of the biggest things I tell my staff and my team is these people are not bad unless we prove that they're bad. There's sometimes you see things where somebody's just a slime ball. You're like, oh, I'm glad to foreclose on this person. You know, and others you're like, I just want to help them. And that's what I tell people. It's like, listen, I understand you're in a bad situation. Like I was on the phone call with a lady one time, a single mom of 4 kids, husband had left. She was trying to put herself through school. Okay, she was in Salt Lake City actually, trying to put herself through like dental assistant school. And I'm like, you know, your husband left. I can see this. I can see the letters you wrote the previous lender. What are you trying to do? I'm trying to do this. I said, okay, we'll work with you. You know, we'll work with you. What can you do? What can you afford? Let's make this a win-win situation. And so what we did is we kind of said, okay, you pay something a little bit monthly. We'll take the amount that you're not paying and put it on the end of the mortgage, like a negative and mortgage a little bit, so that she was able to get through school and then sell the property off. She still made money because the appreciation went back up, but it was a win-win. The cash flow that we were getting in off that mortgage was still enough to be a good yield to us, you know. And so that's why I like actually keeping people in their properties, because we make more money, but it's nothing better than having somebody show up to a attorney's office or they're crying on the phone, and they can't believe that you're actually willing to work with them, you know. I've gotten Christmas cards from families, you know, where they've raised their 3 or 4 kids. We had one lady whose daughter named her baby after me for keeping them in the house, you know, cool. And showing them a way to pay off their mortgage in 6 years versus 30 years, you know. So 70% of the time we're able to keep them in their houses, and that's a beautiful thing. The other 30%, it's a mixture of we're going to give them some money to walk because they can't afford it, you know, like, you know, you literally can't afford this. There's nothing you can do. Let me give you some cash to walk. Let's get you out of a bad situation. And then others that we're just going to foreclose on because, you know, like this guy down in Cutler Bay on a note, he owed like $1.5 million. The house was worth $900,000. He hadn't paid his mortgage in 4 years. He filed bankruptcy, you know, trying to delay things. COVID kicked in, so that delayed things another 12 months to foreclose on. He was lying, saying he was dying of cancer or that he didn't speak any English. It was just all these charades after charades. Ultimately, we foreclosed, and he had the gall to call him up. Hey, well, since you're foreclosing now, can I give you $40,000 to rent the house for like 3 months? I'm like, no, dude, we've given you all these opportunities, and you just kept lying and lying and lying. No, we're not going to allow this anymore. So that was I danced a jig when we foreclosed on that, but most of the time, it's literally being excited that we're able to help save somebody from foreclosure and do a good thing. I mean, I was working with one of my students who's bought a note here in Round Rock, Texas. The lady was in her she was 79 years old. Husband had been dead for 15 years. Kids don't live anywhere close around here. She had all this equity. I think the house was worth about $450. We bought the note for, I think, $175. Okay, she only owed like $250 on it. And she was in foreclosure. When I go to her, I was like, well, we're willing to work with you. If you want to go do a reverse mortgage, you can get some equity and stay here. We'll get paid off and be good. Or sell the property. Well, I don't want to take the time to sell it. I mean, we gave her multiple opportunities. I finally said, well, how about we just give you some cash and you deed the property over to us and you walk away? She's like, you do that? I'm like, yeah. So we gave her $75,000 cash. She got out. She didn't have to deal with the property. It needed some work, but she avoided a foreclosure. She got money to go off and live in an apartment. She actually moved closer to her kids. So it was a true win-win in that case. You know, when it makes sense for stuff like that, we'll do that. But it's, you know, most people just need a friendly, hey, let me pull you out of a hole. You lost your job. The previous lender wants you to pay a year or 2 years. I know you don't have that. Let's create a situation that's a win-win here for you.
Yeah, that's amazing. Being able to do that too, it makes it worth it too, right? Because there's the grind of just doing the daily activities, but when you can actually help somebody and somebody names their kid after you, like That's just like, wow, how cool is this? Like, most people don't get that opportunity
I mean, it's
in their daily life and their normal jobs.
You don't. I mean, and that's a good thing. We make money most of the time by really helping people stay in their houses. That's what we always say. We turn problem properties into profitable solutions. We don't rehab properties. A lot of times we're rehabbing the borrower, actually. Yeah. It's just to kind of get them out of jail. And sometimes people just need help. I mean, there's another deal, like we bought a note in a bulk. It was like 15 notes we bought at one point. One was this little crappy property outside of Cleveland, in East Cleveland, Ohio. Didn't want the property, but I had to take it. Or didn't want the note, I had to take it. I only paid like $1,000 for it because it's in rough shape. And a lady lived there with her 2 kids. And I'm like, I don't want to foreclose on this lady. I don't want to own this property. I was like, you know what? So I just at Christmas time, I sent her a letter, and she was having a hard time. Worked at a convenience store, stuff like that. I said, listen, Merry Christmas. You now own your house. We've forgiven your debt on it. I wrote off what she owed on it, and I didn't even send her a 1099 for it. So just Merry Christmas to you. And I get a phone call from her crying, oh my God, are you serious? Is this fake? I'm like, no, go talk to my attorney if you need to. But literally, here's the document showing you don't own anything. We've forgiven it. The house will transfer. It's in your name already, and it'll keep it there. You've got to pay taxes and insurance, but we're not responsible for you. So if you want to borrow against it at a future date or whatever, you can do whatever you want. You don't owe us anything.
That's cool.
Now, I shouldn't say that because I'm probably getting a rash of phone calls from your listeners. Hey, can you buy my mortgage and forgive it? I'm like, no, I can't.
No, that was a one-off probably. Yep.
We've done it a couple times. We had another lady in Jacksonville who was 85, and we bought this note on this property, and I liked the property, but she was elderly on a fixed income, and we just said, listen, you're old. I know you don't have family. You got a wheelchair ramp on the front of it. Look, we'll take care of it. Let's just go ahead and have you deed the property back to us. You stay in there as long as you want. But this way, when you do pass away, the property's already in our name, and we don't have to go through any of that stuff. And she lived there another 2.5 years before she passed away finally. Yeah. But she kept the property up, kept the AC on, so everything was copacetic inside. So
that's awesome. Well, we've got lots of people who are listening to this, and probably some people are getting interested in investing in notes, note buying, selling, the whole thing we just talked about. Where can they go to learn more about how to do this?
Yeah, it's really easy. You can go to our website. It's kind of the mothership of everything we do with their classes and our podcast, weclosenotes.com. We do have a free class. It's a kind of a 3-hour class for you to dip your toe in the water and see if you like how I teach. And it's called Note Weekend. So if you go to noteweekend.com, we'll show you how we find these, how we fund these, and all the extra strategies in flipping these, and how we make them flow. So I call it the 4 F's of note investing. But go to Note Weekend, sign up for it. We'll send you a 3-hour class. You can watch that. And then if you like that, then you can sign up for one of our 3-day workshops or our monthly membership, stuff like that. We provide a variety of resources for people to learn. Of course, we've got the Note Closer Show podcast that we like to focus on with over 1,000 episodes of me teaching the note business. And we're here to help educate because it's such a niche out there. And like I said, I'm only one of the few people that teaches you how to actually buy direct from banks. No, you don't need to have millions of dollars. You just got to know what to say and who to talk to, and be ready to pull the trigger on something that makes sense for you.
I love it. Awesome, Scott. Well, thanks again for coming on. Really appreciate you sharing all these nuggets of information and breaking down the note business. Lots of moving parts, but I think we gave them just enough to get them interested and get their interest peaked. So you guys go check out that at weclosenotes.com. And you can check out Scott's podcast and some of his other, he's got his free class that he has there as well. So go check that out. But Scott, thanks again for being here. I really appreciate it.
Thank you for having me as well. And if you're listening out there, everybody, do Benson one big favor. We as podcasters love to hear from our listeners. So make sure you hit that subscribe button and then you leave him a 5-star review. Tell him how awesome he is because he's doing a great job here with the REI Hacker podcast. Kicking ass and taking names. Ain't gonna like me, but we know you love Benson, so show him a little love.
Thank you so much. I really appreciate it, Scott. Everybody, thanks for listening. We're gonna have more amazing guests like Scott here on future podcast episodes.